speakers. I want to take this opportunity to thank you all for your support and welcome you to this session, The Future of Digital Lending in India. This session is part of the 28th Convergence India 2021 Expo, and the organizers are the India Trade Promotion Organization and Exhibitions India. As you all know, this is also a year where we're doing a hybrid edition because it's virtual. And I just want to introduce our distinguished speakers today. We have Mr. Alok Mittal, co-founder of Indifi, Ms. Radhika Binani, Chief Product Officer, Paisabazar.com, Mr. Saurabh Sinha, Director, Vertical Head, FinTech and E-Commerce, TransUnion, Mr. Akshay, Mehrotra, co-founder, Early Salary. And our moderator is Mr. Prashant Muddu. I'll pass it over to you right now.
Great. Thanks, Jared. Hi, everybody. How are you? And welcome to the 28th Convergence FinTech India Summit 2021. It's a real pleasure to be here. I think we have a really distinguished panel, that Jared just introduced. And I was going to, has Alok joined? Because Alok was going to set off the panel with, setting context for the entire panel. So Alok, if you could just start off and, walk us through what you see from like 50,000 feet from a digital perspective, and then we'll let that flow into questions for the panel.
Sure. Thank you, Prashant, for having me here. I thought I'll just provide some of the, view that we have into digital lending and where are we finding the opportunity and challenges, and maybe some of that can motivate some of the discussion topics for all of us later. So clearly, I think, from a potential standpoint, BCG has called this out to be a $1 trillion opportunity over the next 5 years. Right. So this is probably one of the most compelling opportunities in terms of market disruption and the shift that's expected to happen. Last year, already more than 50% of personal loan and the MSME loan market was served digitally. Right. So about 2/3 of the loans that were done were digitally influenced, and more than 50% were served digitally. And we have really seen a spike in the consumer digital behavior across multiple categories, but certainly includes digital lending. Within our own business, about 1/3 of our customers would sign electronic dockets pre-COVID. Today, that number is at about 85%. And we deal with the MSME segment, which is not considered to be the lead adopter of technology. Right? So there are very clear signals available around the potential of this space and the willingness of consumers to adopt these technologies. I think from an impact standpoint, really one of the fundamental shifts that we are seeing happen is that conventional roles are getting disrupted, right? So the bank as an entity, which is both the customer front end, the data middle office, and the capital back end, is getting carved out more finely, creating opportunities for partnerships, right? So you have the front end partnerships between aggregators and lending institutions. You have the separate set of data companies, initially led by bureaus, but now several others of those, coming up with support the entire decisioning and account monitoring process. And then you've got back-end partnership, lenders to lenders in form of co-origination, arrangements, marketplace arrangements, and the like. So one of the questions that I think would be interesting for us to, consider at the panel is really where do we see these partnerships leading to? What are the stable state roles that each of these entities start to presume over a period of time? And hence, in some sense, which of these partnerships are really strategic versus, tactical? From an enabler standpoint, clearly public infrastructure has been the big enabler for this. It has evolved so fast that the terms and the acronyms for these are getting forgotten quickly, right? 3 years back, we were all raving about JAM, the Jan Dhan, Aadhaar, and Mobile Trinity. And now that's almost a given. I mentioned some of the adoption of digital signatures, electronic ECS, and all of that. But really, looking at the horizon, the account aggregator promises to be a big enabler. In some sense, that is about putting the customer's data in their own hands and giving them control over how they choose to use that data. There is the whole public credit registry backed by GST and e-lien mechanism that was envisaged in the UK Sinha committee report, which provides essentially a mechanism for working capital financing, which is more seller-led rather than being buyer-led. There are recent developments around TREDS and OCAN, right? And what all of this is doing is it is allowing large lenders to adopt a uniform set of APIs and enable their lending processes rather than for this to be built in the private space, literally one brick at a time. So again, from a panel standpoint, I think one interesting question to consider would be, what are the panelists finding most useful amongst this infrastructure, and what are the one or two things that are missing from this framework or in terms of implementation that we could potentially then try to expedite. Digital lending is creating its own set of challenges. Some of those are reflected in the recent RBI committee that has been set up, some of the frauds that happened on digital lending applications. There are clearly issues of data governance, privacy and consent enforcement, and hence what kind of policy interventions will be required to scale up digital lending in a healthy manner. We've seen in multiple parts of the world that digital lending has scaled up fast, but then also crashed down because of lack of governance. I would propose that be kind of the third key pillar of our deliberations today. So really look at the partnership space, the public infrastructure space, and the policy space as the three core drivers for digital lending. With the view in mind that customers probably are moving much faster than any of us in terms of their acceptance of these solutions. So, with those initial comments, and thanks for the opportunity to present those, Prashant, I'll hand this over back to you to begin the deliberations at the panel.
Thanks, Alok. Wonderful. So, and in fact, there is no bank on this panel. So, and I think all of us together, work through with different partnerships at different points in our journey. So, maybe we can start with Radhika, then Akshay, and then Saurabh, and then just comment on the partnership landscape and the infrastructure landscape and what you're seeing as where you see the trends and what's beneficial, what can we do to improve. So, Radhika, if you can help kick us off on that.
Yeah, thank you. Thanks, Alok. In many of my panels, I used to always talk about 4 Ps of FinTech, which was products, processes, patterns and data, and partnerships. And now I've added a 5th one, which is public infrastructure and regulatory environment. So thanks for the 5th P. With that, I think partnership is like very, very core to us. So we don't exist without partnership because we are a marketplace and we have partnerships with more than 50, 55 different NBFCs, FinTechs, banks across in the lending space alone. So I think partnerships, what I've seen is it's evolved quite a bit over the last 3-4 years, more so in the last 1 year. I think we'll talk about what's happening now and what happened in the last 1 year. When we looked at our sister concern, which is Policy Bazaar, during the same time last year, so they were sitting pretty. We always thought insurance is like deeply regulated. They are slightly behind, but in terms of digitization, they were much ahead. So even when Corona happened, they were hardly disrupted. Their operations continued as is, and in fact, there was huge increased surge in demand, and operations continued as is. And they quickly moved to telemedicals, and there are a lot of process innovations which happened. So the business continued as is. But on the other hand, lending almost came to a standstill. And one of the key shifts which have happened in our partnership is all of us talking about the same level of digitization and looking at it from customers' end. So the couple of points which Alok mentioned, where the customers are ready, the demand side, people are ready to move to digital, tell what you want, they are ready to do digital. It was always the supply side, and for us to be able to get the digital processes right in front of the consumer. I think where we were close to single-digit number of applications which were completely digital, 100% digital, has now moved to around 20-25% of the applications that we see, which is at almost pre-COVID levels, which are completely digital, and many of them are almost 70% digital. So I think digitization and the partners, we are talking the same language at this point of time, and we can see that accelerating. And second is, of course, in terms of how the patterns or the data can help us co-create some of the products. So there's a lot of work which is happening in terms of saying, okay, this is the kind of customers who come onto our platform. This is the segment gaps that we have, or these are the innovation gaps that we have. How can we together create an offering which makes sense to the customer, and it's a win-win-win for all of us together? I think these are the two broad things which are happening in the partnership space. With respect to infrastructure and regulatory, I think I echo the same parts. There's a lot of positives which have happened. The many of the eKYCs or the video KYC, the CKYC, there are a lot of positive steps which are happening in that direction. And with account aggregator, all of us are looking towards that being the center of plate for all of us, so that we are not scrambling around for the data to come from different pipes, or the customer is scrambling around to give us the data. So there's a lot of positive moves. We hope for the next 6 months, 7 months, all of it comes together for us to be able to serve the customer completely digital.
Thanks, Radhika. Akshay, would you want to say your piece on that as well?
Yeah. So, Alok, thanks for setting the agenda. I think today consumer lending is going through lots of ups and downs, right? I think what we are noticing is there was a pre-pandemic stage with just a recovery happening from NBFC crisis when we got hit by COVID, right? But it made two things really come alive. The first part was the capability of mass volume customers continue, but at the same time, the business model had to be tweaked where the co-lending partnerships really came alive and become large. So I would say, let's say sometime early last year, we used to say we want 90% on balance sheet. And today we are building capabilities of being 50-50, right? Which is very important. So 50 is for the hyper speed. So we can deliver money in under a minute. The balance 50 is to make sure that we can lever better. We can give more money to better deserving customers. And that blend is becoming the need of the hour, and which actually had a lot of tech interface which had to be done. If you have 10 lenders at one side, the amount of integration effort is humongous, and getting those lenders to that tech interface is a big effort, right? The second part was, I think, the invisibility of credit. I think in the B2C space, affordability is becoming very important. We decided to invest in 3 lines. One was going deeper with the corporates so that we have a payroll deduction product running. Today, we are live with 700 corporates, really fueling the way we can access people. On the other hand, the affordability product coming in because of buy now, pay later is allowing consumer credit to focus on areas where there's a demand. So in the pandemic, we saw spends ratios come down. Many people have stopped taking Ubers and ordering food at office, etc. So the expenses have come down, which meant they'll now start buying assets. And if they're buying assets, the biggest component is invisible credit or buy now, pay later, which fuels the growth of consumer credit. I think the third is we just are, I think, recovering from the forced pressure coming in between the regulator and what happened with spurious or Chinese lending apps operating in India. And I think the good part, we all saw at least an attempt by the FinTech companies to set up a FACE, which is a FinTech association, trying to put together what is the right way to run the FinTech model. And I think that's fueling the growth in the entire ecosystem. The good news is, let's say as a company, we are almost 20% more than COVID, right? Or pre-COVID numbers, which is great numbers. We are profitable. I think I talk to my peers, all of us have got our volumes back. And now as the market is much more open to digital systems, I think as an industry, we are pretty confident the next 18 months would be a 5x growth for the FinTech lending companies.
Wonderful. Thanks, Akshay, for that. And of course, I'll pass it over to Saurabh as well, who has the unique capability to see across the entire market and probably see data that a lot of us don't get to see it in many ways. So, Saurabh, if you could also just lay out your perspective and how you guys see the entire ecosystem.
So, Prashant, thanks for that. Though at the outset, I won't start with a lot of heavy data, right? We have been held guilty of doing that many times. But what I will do is keep my responses largely to your question on the importance of partnerships, right? So it is true that the pandemic had caused large disruption to the credit markets. However, it is also true that the Indian credit markets, and for that matter, many other digitally powered industries, have been very, very robust, right? They've actually shown massive rebound. I can talk for the credit markets of India. We are already at 97% of pre-COVID credit demand month on month, right? So we've achieved those levels. The supply has also come back. Of course, the supply is a little more conservative, right? The risk appetite has gone a little bit. So policies have been tightened. There are still liquidity challenges with smaller NBFCs. So those need to be solved for. And to Alok's point on policy and regulation, we'll maybe address these later on. But the long and short of it is that the credit markets have been very, very robust. COVID caused a very temporary disruption to the credit markets. Now, what's also though happened thanks to the pandemic, and I know it's had a massive, let's say, impact to human lives as well as economies, right? But outside of that, it has pushed digital adoption, in my opinion, ahead by at least 36 months, at least 3 to 5 years for sure, because behaviors have changed. And we're seeing that, right? We're seeing massive amount of repeat purchase from the same lender brands, right? This was not the case earlier. Small ticket loans, BNPL, which was being spoken about, is not really now solving for affordability. It is solving for convenience, right? Because you don't want to go and, swipe a credit card or a debit card anymore. Why even have that friction of an OTP when BNPL is just one click? So those things are now playing out. Of course, the culture around credit in India has also changed, right? With the younger Gen Z population, the younger millennials as well, right? They don't look at credit how older millennials used to look at credit or the Gen Y used to look at credit. So all of these are happening in parallel. And then you've got payment companies, digital payment companies moving into lending in search of higher profit margins. You've got lending companies who've, let's say, burnt their fingers with certain, strategies in the market, moving to neo-banking players, moving to platform players, SaaS platform players. You've got big tech companies, which are global behemoths coming to India and launching financial services, players across entire financial services. So you now have a very, very complex ecosystem that's now emerging. You've got government initiatives, you've got iSpirit, you've got Oken. There is so much of data, there is so much of disruption. There are many, I'd even say, overlapping initiatives that are being run by private companies as well as government entities. And when such a complex ecosystem, which is changing month on month, is there, it's extremely important to understand the lines have blurred. What you need to do now is you cannot have just one identity. The consumer expects much more out of you, and hence, where you don't have core capabilities, you have to innovate. You have to either build in-house or you have to go and partner. I think I can speak for TransUnion, right? We've had this realization for several years now that we cannot build every new product out there. We cannot build every new technology platform. There are things that we aren't very good at, and it's important hence because there is so much disruption, so much innovation happening, let's say, even in the FinTech ecosystem. There is so much of IP that is getting created. It just makes sense to partner, right? So we've actively been looking at ourselves as a big data company. Bureau services are just incidental. We're a big data analytics company, and I'm probably even speaking for other bureaus as well. I'm sure they resonate, this kind of an identity definition resonates with them too. And hence, when you just look at data as the key asset, not necessarily traditional credit information, what you realize is massive players out there on alternative data exist, on bringing government golden sources together to solve end problems for large businesses, right? So we believe we're in the business of not creating everything in-house, but really finding out what's the best out there, marrying it with our own strengths and creating new solutions for our business customers. So that's, in my mind, the most straightforward, reason why you should look at partnerships and how we're looking at partnering in the coming few years. And this is no different from what I'm hearing in the ecosystem as well. Everybody is trying to partner on the account aggregator network. Will it be massive? Of course it will be massive. But who knows when that will gain scale? Sure, looks like it's around the corner, but I'm not 100% sure if it's 3 months or is it 3 years. I'm not sure.
The table, what partnerships and maybe if you're at, if you can say so, what partnerships do you think are, strategic or tactical? What partnerships have worked for you guys? Is it largely data kind of partnerships? Is it, acquisition in terms of, where you're getting sourcing from customers? Like what do you guys see, and what do you see, which partnerships do you see play out in the longer run?
So, Prashant, it's hard to comment on that right now, simply because I think partnerships need time, right? Just like any relationship, partnerships need time. Initially, it can all be hunky-dory, but once, the partnership is in trouble, it doesn't scale. There are, let's say, one-sided views on what a certain profit sharing should be or revenue sharing should be. Those issues come down the line. But I can tell you, we don't look at partnerships as, let's go and do an alternative data partnership. Let's now do a platform partnership. No, I think that's the outcome. What is the input to that question is, what are the critical business issues that my business customers, which tend to be, by the way, banks and large lenders, what are they solving for? So I can tell you today that largely most bureaus in the country have specialized in helping underwrite cases, right? Underwrite loans. That's the core, value prop. And I think something that comes next is portfolio management, which is once you've acquired a customer, how do you manage your entire book? However, we realize that a bank spends massive amounts of money on collections. It is also very manual. It is largely not disrupted by technology in the last decade or so. There is minor disruption. Sure, you have dialers, you have call centers and all of that, but I don't call it true digital disruption or automation of sorts. Yes, chatbots, all of that is happening, right? But it's not, I'd say, big disruption. So we started thinking, how do we solve the problem of collections? And then we started thinking, hey, is it a platform? Is it automation that's needed? If automation is needed, go look at a platform player who's operated in this space, has seen some success. If it's missing data, which can be an informer on how they pay their credit, how their current liabilities or obligations every month stand, right, on EMIs. We go and solve those pointed questions, whether it's data or platform is I think, a second level decision. The first level decision is what we look at. Just to share with you some of the initiatives that we're looking at for partnerships are, we are looking at digital payments very seriously. So we've been partnering with a lot of digital payment companies, both on data as well as some fraud prevention problems there. We've been looking at very large problems like agri, like rural. These are massive issues. These haven't been disrupted by technology. So there is a clear case to be made for these kind of digital partnerships. But again, I mentioned collections. There could be many others. Look, we just feel these are the low-hanging fruits. But partnerships, by definition, is an infinite area, right? You can even look at partnerships for what I call acquire or loan underwriting, which is usually the bread and butter of most bureaus. Even there, you can look at partnerships. So partnerships is about reinventing yourself and, setting yourself up for the next 3 to 10 years. And that's what we look at, when we talk about partnerships.
Great. Thanks, Saurabh. Anyone else like to comment on that before we move on? Sorry, I'll let Radhika go first, Akshay.
So my view to partnership is that just categorizing into two simple ways, right? When both are in the same field. For example, all our partnership with banks and FinTech, that works beautifully because we are solving towards the same thing. The second kind of partnership which works well is when they are enablers. For example, we have long-standing relationship with all the credit score companies, bureau companies, to help customers sort of track their credit scores and manage their credit scores. So that is an enabling field that works beautifully. But what I've seen does not work as well is like when we say that, okay, you have a pool of customers, I have these services with me, why can't they use their pipes? Because what I feel is when two companies have at different stages, so it's like there is resonation needs to happen, right? Then you have to be at the same frequency, but then there will be different frequency because each company is fighting its own battle. And when there is a challenge, then they say, okay, this is secondary, let me solve my core first. So in those kind of places, the partnership breaks down. That's point number one. And two, with companies like us, the pace of expecting a partnership to work is very high. high. Like Saurabh mentioning, it's a 5 to 10 years. So I think for us, 5 to 10 years is like a really long time. So I think that's where some of the partnerships take time to mature. But while they're important, what I've seen of accepting enablers and direct partnerships, I'm not that optimistic to look at long-term different kind of partnership at this point of time.
So I think the first level partnership is always starting with sourcing, right? So I think we noticed that the first level of partnerships were creating SDKs to go power anyone in the world. So from an aggregator to a mobile OEM to a, let's say, a neo bank powering, or a UPI app. How do we power all of them in lending capability? And that's what the innovation with the SDKs we started seeing. But I think the most important wave that I think that started close to 2 years back was the tech platform partnerships. What actually resulted is core to you is the decisioning science, right? It's not tech building and hosting your rule engine, etc. So I think one of the biggest innovation we did was work with the bureau, because they host lots of rules, right? We said we'll give you the rule to host it, so we will not spare infrastructure of building. Now that actually reduce the number of people that we need to manage the backend services, right? It allows you to then focus on building analytical practice in your team. The second level of tech intervention is now taking place. Players for innovation. See, I think the only way fintech can compete with banks is they continuously keep innovating. Innovation is a very double-edged sword. You can invest a lot of effort in it, and results are going to be far more lower, because those results actually come in IP and valuation. They don't come in core business value, right? Which means that you have to be willing to every new innovation happening. How do you use it? If there was a VKYC happening, can you be the first one to launch it? You don't have to build, someone else is working to introduce that. You have to make sure you have the best partner chosen to implement. If there is an account aggregation platform up, how do we be the first one to use it? If you have a fraud mechanism up of someone else, how do you plug and use it? Fintechs have to stay ahead than the market. And today, if you look at it, we are always focusing on 18 months ahead. So what you are seeing today, people are introducing in banking in large companies, someone will come and ask, where did you do the pilot? In most cases, they come and say the pilot happened early salary, because we were willing to take the risk 3 months back. Otherwise, you're investing in your own tech to always building innovation, which is too expensive. Right? So piggy banking and partnerships for innovation is very important, and that's how businesses get built.
Wonderful. Yeah, that's a really great insight. Thanks, Akshay. Alok, would you care to comment before we move on?
I think some great discussion. One of the things that we've noticed is, and I think Radhika pointed to some of this, in many of these partnerships, value is getting redefined. So, for example, banks have treated origination channels, DSAs classically, with a certain value construct. When you go to ecosystems that also bring you differential data today and bring cash flow control and things of that nature, right? Both the parties believe that they should control the disproportionate part of the value. So I think those things are going to settle down as we move forward. But there is fundamental re-architecting of where the value lies in a lending business. And that would be an interesting one to see evolve.
Yeah. So, and one of the things that, from this partnership perspective, and I think Saurabh also alluded to this, this is a really complex ecosystem, because you have so many players that are now part of it. And, you probably are getting redirected 2 or 3 times during this entire journey across different players. There's massive amounts of data that is starting to get available and shared between different players. And so one of, to me as a layman consumer, I have 2 concerns, right? Where is the governance around all of this? Because where is my data being shared? Do I really understand who's accessing my data? Where is it being used? How is it being used? And of course, the whole infrastructure / governance, pillar that you guys spoke about. So, I just wanted to kind of move on from that partnership and say, because we are in this complex ecosystem, where do you see any gaps, if at all? What are some of the things? And I know you briefly spoke about NBFC AA, which, we're all waiting. I certainly also have my reservations in terms of how quickly this is going to come about, because, Radhika spoke about the fact that everyone's speaking the same language, but it takes a while for all of them to speak that language, come up to the same level of, technical sophistication for us to be able to smoothly run a journey across, which is entirely digital. So from an infrastructure point, where do you guys, we've spoken about NBFCA and Open, do you see any gaps? What would you like to see improve? And probably talk about, who is going to be able to effectively govern this, given the complexity of, the journeys itself, and where do you see that? So, Radhika, we can start with you and then go around the table.
Yeah, I think it's quite complex, and currently all of it is concentrated at, like, say, one regulatory power, and the pace of change is very different, right? So with a lot of innovation happening, regulation needs to catch up. So I think what happened with respect to the fintech apps, all of those are examples of things which can happen, and it takes time for the ecosystem to catch up and figure out how to do this regulatorily. There are one or two things which from the data privacy point of view, the other often repeated term is the data privacy bill, which will assume that there's some amount of regulatory oversight, which is nothing to do with this industry, but across all industries, where the customer will be able to manage his or her own data. I think that's one thing which would help in some way in terms of being able to manage the data privacy of that particular customer. Who owns the customer's data? It's the customer himself, and will have the ability to do that. Secondly, with respect to other kind of fraud and all of that which is happening, there is, I think, action happening with respect to the committee which is being put up, and there would be some things which would come up, and I think that's something which will fight itself out. Otherwise, I think in terms of infrastructure, we are looking towards say CKYC, which is a common infrastructure which has been put up. While there have been talking about it being working well, but the participation rates are very low, and when we speak to different partners, each of them have their own interpretation of who is to give data, who can pull out data, so it's subject to too many interpretations. So I think before we have the leap of, like, while account aggregator is the next leap, but I think the current leap of whether CKYC, EKYC, video KYC being much more smoother than current implementation, I think if we sort all of that out, given the current situation of conducting business digitally, I think that would be the biggest ask before we sort of do the giant leap of AI and things like that.
Wonderful, thanks. Saurabh?
I kind of agree with what Radhika is saying. Look, I don't think the NBFC AA architecture will completely solve for it. The Sri Krishna committee, had shared some inputs, and I think there's further evolution of the privacy laws, the privacy bill, which is expected very soon, right? So where is it headed? It is all headed towards a new world where we've got two conflicts, right? We've got this whole want of using data for good, right? Because we are in this whole age of data is the new oil. But at the same time, we want our privacy to be protected as well, right? So I see a clear conflict. And that's why DEPA, right, which is the Data Empowerment and Protection Architecture, has a very interesting view, right? Their objective is to enable safe and trusted sharing of data in which privacy is preserved. So the future is surely going to be towards consent-led access to data, and it has to be very contextual, meaning the use case is very defined, and how long you have access to what fields of that universal data on a consumer, right, is going to be very, very defined, right? Now, who will define it is the other big question. The NBFCA is not any silver bullet, right? It can't be. So I definitely feel other bodies will have to come to the fore. The problem is we've got so many different regulators which touch financial services. So no one regulator can be, entrusted with building this, and hence I automatically think of the government. And then there's another problem there where certain governments have been blamed of using this data, recording this data for different purposes. So I don't know what the final solution is, but for sure this rampant access to data, this rampant capturing of data is not going to stay here long. Businesses, at least mature businesses which ethically operate, are already investing in being very DEPA compliant, right? They're not waiting for all of these privacy norms to evolve, and one fine day some disruption will happen and then they'll start their thinking. Trust me, most of the organizations I know who are powered by data, their core businesses around data, are looking to be DEPA compliant as of yesterday. I can speak for TransUnion. We've been thinking and doing a lot of things on that, as would be many other bureaus. We are, when we partner with data fintechs, also very, very careful about what liabilities we take on, what liabilities we don't take on. So we are very careful on that. We respect people's privacy. Having said that, I'm sure all businesses do, but a new framework is required to enforce this. I don't think enforcement is right now uniform. It is left to each business to operate as they want, right?
Yeah, well,
I think there is an element of there is an element of this. Yeah, there is an element of governance architecture that will go beyond DEPA, right? It's the practices. So, for example, if a digital lending app is scraping my contacts for the purpose of collection calling later, and they have taken my consent to do so, they have a defined purpose with which they would use it, right? So they're compliant with the law, right? But is this a practice that is accepted within the industry, or the industry pushes back against it? I think there is a role for self-regulation around some of these, commonly accepted practices, going beyond the, mandate of the law. So I think that's the harder one to think through and resolve.
Alok, I couldn't agree more. And I'll just say that that's the next dimension. After controlling access to data, respecting people's privacy, what that business does for the time they have access to that data is around their procedures, their processes, and their ethics will matter. Again, I don't think regulation or control or having a control framework across the country can be the solution. There will be malpractices always. People will pay for all of this. Yeah. Sorry, Akshay, you wanted to come in?
Yeah, so I see. I think there is a lot of noise that we saw about consumer data being used inappropriately, management of the data not being done. Many of these platforms were hosted outside, which means they were taking private data of the consumer, including Aadhaar, etc., outside the country and storing and using those credentials, scraping contacts, etc. And I think the biggest answers came and said that there is no assistance body in lending like an SRO today, right? And as we built FACE at early salary along with other lenders, we noticed that one of the first things we came out was actually putting up a code of conduct when we asked, why do you need this data? For example, why do I need to access your photo gallery? It's the most ridiculous things to ask for, right? I need for doing KYC, I need this photograph. I don't want to see all these other photos. Exactly. But we actually went back to each lender and asked what are they doing with it, found out the answer, then said, if you want to become a member of us, you have to stop this access. Then we actually went back to Google and say, if we publish this, can you enforce it properly? Right? So these are the apps which are not taking access, the ones taking accesses. So that how do you go and build? But the bigger question which remains is, only some of the bodies are audited and controlled by the regulator. There are many people who are still not regulated. Right? So the World Wide Web is a complex piece. You can have the Google Play Store, but there are 30 other Play Stores which are not regulated. Right? Mass India will root their phone so they can access a free game. Right? And those are the devices where the bottom of the pyramid, there's a lot of concern about what's going to happen to them. Right? And it's very important that a combination of regulator, a combination of an SRO has to get created, the consumer gets protected somewhere. And that is I think the next 1 year will see some work being forced by the regulator to do it. And I think that's a good step.
I think that's a great point, Akshay. Sorry, Prashant, if I can take half a minute. Akshay is talking about FACE, which is a great initiative. I've been speaking to Akshay on this. It's a self-regulatory organization. There is one more, which is DLAI, but I think this is a great example of an ecosystem. The prime players in that ecosystem who stand for certain principles, coming together, forming a body and trying to enforce it, as a way of including more members, right? Like Akshay said, there will be always those on the outside. You can't control everyone, but at least when you get associated with these kind of SROs, what you're saying to the end consumer is, I stand for good business practices, I stand for ethical business practices, and SROs, I think, have a phenomenal role to play in the future, because we discussed this enough, right? Not everything can be controlled. Some things have to be self-regulated, right? So I think it's a great point Akshay makes, and I'm really looking forward to FSE and DLAI really expanding their play.
Wonderful. And, one of the things that I have been seeing that increasingly is starting to happen is people who have data and have access to data are kind of almost going the bureau way, where they're putting out a score for that data, right? So, and that score indicates something, so that at least they don't share the underlying data, but they're able to share a score that talks about whatever that they want to talk about, whether it's the buying, the spend pattern, whether it's the behavioral score of that customer. So one of the ways in which we're seeing, and you guys spoke about organizations that are very conscious about the data that they control and what gets shared, are moving towards this, concept of sharing a score, which is going to present its own complexity, because now I'm dealing with, a spend score, and then I'm dealing with a bureau score, and then I'm dealing with, let's say a behavioral score, or a psychometry score, and all of these scores that are there. And so for someone to kind of piece all of this together and underwrite a customer for a loan is going to get increasingly complex with, data being shared in maybe these constructs. So that's something that I've been seeing as a trend. I maybe take final comments before I move on to the next topic on that.
If I could respond, Prashant, since we're in the business of making scores and delivering scores. Prashant, the way TransUnion looks at scores from raw data is actually no different, right? If scores are derived from raw data, they need to have the same privacy norms applied, because it is derived from there. It still represents something about the applicant, about the end consumer behind. So if anybody feels that just because they masked the raw data, but they've derived some information out of it, and that's fine, it should not be treated as private confidential information, I'd beg to differ completely, right? It is still using somebody else's data. Maybe you captured that data without the consent, express consent of that consumer. So we have a disconnect there, and that's not, let's say, the way forward. I think it's a temporary approach, right? The other thing is, all of these scores are just developed in situ. What I mean is, there is no back testing done on industry data, right? 2 years back, social media scoring was a big thing, right? Every large lender was thinking about, social media scoring. I mean, people travel abroad all the time. Just because you traveled abroad doesn't mean that you're affluent and you're low risk, right? Vijay Mallya also traveled abroad. He's not low risk, right? So social media scoring died its natural death, right? Similarly, I feel any score, any offering which hasn't been tested on large amounts of data, which is statistically significant, doesn't have data science basics applied, won't scale, and certainly doesn't cover you for privacy requirements.
Just to add some interesting anecdote, last week I was speaking to somebody who could look at your photograph and predict your health score only on your predicted BMI and your health risks, and basis that you could take yourself as insurance. Just adding so that we know what kind of scores we are talking about.
I'll never get a loan in that scenario. Okay, wonderful. So we spent a lot of time, and I know we have a substantial audience that is live, and before we spend some time taking questions, we really truly didn't talk about the rebound from COVID, and I know Akshay and Saurabh, you all did mention that the numbers were back. But what I wanted to specifically talk about is the context of all of you all talk about new to credit and where it's coming from. Radhika, I think you guys are in over 1,000 cities, and you're seeing a lot of demand come from tier 2 and tier 3, and where we're able to, and especially now with the whole digital ecosystem kind of clicking through in some sense, we're able to get deeper and further and in terms of reach. So I just wanted you all to talk about that in terms of what impact digital has had. Obviously, because of COVID, we know it's leapfrogged everything as Saurabh said, but kind of talk through the rebound story, give everyone who's listening a flavor for, are we seeing it truly come back? Is the news positive, or how do you all see the road ahead over the next couple of quarters?
So I'll go first. So I think we are also around 80-85% of our pre-COVID levels, and that's pretty exciting. And what's different, the 85% is we have structured ourselves very differently. So it's sort of almost like you rebuild the business very differently, more focused on profitability, sustained profitability, rather than only looking at the top line. So this growth gives us great joy, even if we are at 80%, but like much more profitable. I think that gives us great joy. So I think we've used the time to put in certain anchors which would help us going forward. The first one is building the digital stack so that whenever the partners are ready, we are ready to take off with them to make it 100% digital journey. As of now, we are at 25-30, inching towards 30, but then we are hopeful that this number will go up over a period of time. That's point number one. Second is we've been able to also work on a couple of say co-created products, especially targeted towards new to credit segments or credit poor segments, which is less than 700 score, to help them rebuild their scores. I think that's a big gap that we see while the demand is coming back, but the supply to new to credit does remain challenged, or the credit starved customers does continue to exist. So I think that's something which we are looking to look at, how we could co-create certain products and get these customers served. And of course, working on some innovative products with respect to, say, line products, so that there is some innovation rather than just looking at the same kind of products which the customers have. So it's been an exciting 1 year, and the next 1 year, 1.5 years seems more promising.
Wonderful. Alok?
Yeah, thank you, Prashant. I think the scale is going to happen, right? That ship has set sail. I do think that in much of the excitement over the last few years around digital lending, people have not really absorbed what it means. So many of our partners, are on the bus with us because, the bus is going to go to an exciting place, but may not have necessarily absorbed what digital lending means and what disruptions it will cause. So for example, I think one of the things that will, dampen the growth of the industry is whether the capital supply systems, rating agencies, the lenders themselves, do they really understand, how digital lenders view risk vis-a-vis how conventional organizations have, right? So traditionally, NBFCs are very, very narrow band businesses, single product, very narrow pricing band, and hence quality of customer. A lot of our digital lending peers that I talk to want to be very broadband, right? I'm sure, our friends there want to do loans for everywhere from 15% to 45%, because that breadth is available and digital credit models allow you to span that. Now those things become very hard to explain to lenders and to rating agencies, because they see this as not being focused, right? So I think some of those conflicts are going to start to surface up, and my sense is that on the supply side we will face challenges to growth, driven by this lack of understanding. So it is in our own interest to start to educate the market more and more about some of those elements.
Wonderful. Akshay?
Maybe I'll drop some numbers. So Jan-Feb March last year, we got 1 million people asking for money. This year, we have already crossed that million this Jan-Feb March, and we still have like 7 days left. So numbers are back. The other interesting part is that the ticket size has gone up by 3 times, while our risk approval rate is at least 50% lower than what it was, right? So there's a great shift happening. That means you are now able to attract more consumers which are higher in quality because the banks have still not opened up, right? And that means that there is going to be a huge growth rate which can happen in fintech businesses. So banks have raised their bar. They have raised, while they become digital, but they still don't know how to get that customer in, which gives us a huge sweet spot, right? So I always say if the customer is less than 30, fintechs should be the one who take on that customer. We typically attract a customer 10 years younger than a bank, which means it's our job to hold that customer for 10 years, which is our innovation has to next grow. fintechs have to have more products coming in, more moving from a line product to BNPL, to have cards, to have anything an unsecured line to have available. And that's what's now fueling the growth rate, right? So we're surprising to the bullishness which is coming out in the business is interesting, that new age fintech businesses can risk rank the consumer better. They can now attract more better quality customers if they're able to do a 3x improvement in customer quality, which means that they don't have to worry about a treadmill approach. They can now go build large balance sheets. So the year is going to flip from large amount of demands, building balance sheet play, which was difficult in fintech. And in the next 2-3 years, I think there'll be at least 20 fintechs which should have more than $1 billion of a balance sheet each, which is that actually talking about what banks hold up, and which is an interesting space to be. And that's what we're all focusing on.
Wonderful. Saurabh, you want to round that off?
Yeah, sure, Prashant. So, as many panelists mentioned, younger consumers, especially under 30, will be the future. Demand from non-metros will be the future. Another emerging trend that we are seeing is the growing presence of women on the bureau, women seeking formal credit. So these are all growth areas, right? Like non-metros today account for over 70% of most of the loans done, right? Under 30, I mean, in the new to credit segment, half of the customers coming are young and under 30, right? So, but let me actually not use the NTC lens too much, which is the new to credit lens, right? Because like some people mentioned, new to credit over the last 12 to 18 months has really started declining, right? Typically, when you look at the bureau, about 30% of all credit demand comes from the new to credit segment, right? But the approval rates are close to 18%, right? 18% of originations happen to new to credit consumers. Their digital lenders, specifically fintech NBFCs, have done a phenomenal job, right? So they receive about 40% of the credit inquiries from the new to credit segment, whereas the approval rates are 30%, right? So it's far more than other lender types, but there is still that gap of 10%. That is an opportunity, obviously. At TransUnion, we've been looking to solve that problem as well. We've launched a new to credit score, which works on bureau lookalike population. We're trying to bring in more alternative data because you don't always need credit information, right? And digital lenders are also very future forward, right? They're very innovative. They've got open credit policies. To what Akshay mentioned, when banks become conservative during this time, and I did mention they have become conservative, there is a throttling of the risk bands. They are looking at prime plus, super prime segments. There is a massive opportunity for digital lenders. If they have access to capital, which is the systemic issue that Alok was mentioning, if we solve for those, there could be a massive acceleration of digital lending once again. I told you that the rebound has happened. Now they're poised for growth. The growth areas could be non-metro demand. So you need to localize for those regions. And I mean localized languages. You need to look at women, demand from women. You need to look at the new to credit more seriously. And yeah, retention is a big play, right? I mean, I can tell you, when I analyze the last 3 years of personal loan lending data, I can tell you that the incidences in 12 months of borrowers borrowing from the same lender brand, right, is about 140x for digital NBFCs versus other lender types, right? Do you understand the massive gap, right? If I go and borrow repeatedly from, let's say, a large private bank, if I have ever experienced a fintech NBFC loan, I am 140x more likely to consume from them. And what does that give you? It gives you a much higher lifetime value of the customer. Sure, you've got smaller ticket size loans. Sure, your cost of acquisition the first time around can be high. But when you look at 20, 30 such loans taken in the space of 18 to 24 months, there you're talking about a very profitable business, right? So I think the future can be bright. Of course, you have to understand that sometimes fintech lenders can look at this as a GMV building business, right? Meaning customer acquisition growth is more important than building book. And I think some realization of that has happened due to COVID. So I think now that this rationalization due to COVID has happened, now everybody will think like a part banker, but a part technology evangelist, right? So that perfect combination is now going to play out a little bit more. So I'm expecting higher profitability plays in the fintech ecosystem. And I hope that gives you a large sense of where the future is headed.
Well, that does. Thank you so much. So we have 5 minutes, so I wanted to take a couple of questions. One of the questions that's come through that, and it's interesting, and I thought we'll just talk about it. We've all said alternate data, and so the gentleman wants to know, what are you guys calling alternate data? Because obviously it's not social media data anymore, and when we know
I'll answer
all that. So so Akshay, why don't you go ahead?
Okay, so we now define alternate data in a very interesting manner. The first is apographic behavior of the customer, how fidgety he is while he's filling up the app form. Right now, that is the most complicated app movement to get captured on finger movement on screen, but that's what's now fueling the nature. The second is sound mnemonic. Right? When you interact with us, what do you say? What does that word mean? What is the seriousness and desperation to borrow or willingness to pay back? Now, that's a very interesting way of looking at data, right? And the third is accessing data which is provided by the consumer. And today, apart from the bureau, the account aggregation platform is the largest supplier of that data. Right? I don't want to comment. I think the original format of alternate data, which was like social media or scraping things on the phone, died 3 years back. We all moved out because we knew that it's not something that we can build large businesses with, right? And I think that's very important, right? The two new data structures which are coming in are so difficult to understand. But if you have a strong analytics team, they can find the right answers. Of course, I always joke that if you ask the correlation between stock and rain, there'll be some correlation available, right? Stock prices go up and rain happens. Unfortunately in lending, your scorecards have to run at 99.2 to 99.3% efficiency, while I would say machine learning scorecards, if they run 80%, you can go and sell them for a few $1 million easily. Lending is not as easy as any kid making a scorecard.
Wonderful. Thanks, Akshay. That was insightful. Radhika, any examples of alternate data from your perspective?
So our approach is pretty simple, right? See, we are not the ones who are undertaking the risk. So we are like, show me one fintech or one bank. If somebody comes to us saying that we have this alternate data, you can do something. I said, show me one bank or one fintech who's ready to do it. We partner with most of them. If they're ready to do it, I am willing to take it from the customer and pass it on to the bank. So it's very simple. As long as you're watching it, obviously it's interesting to do these discussions to figure out what all can you potentially, and as a customer, what are the footprints that I'm leaving. It's good to sort of have those discussions, but for us the objective would be when a bank and fintech is willing to underwrite, we will go ahead and get it from the customer.
Okay. Alok, they were specifically interested in any alternate data for MSMEs.
Let me just take one example that we have seen to work. We facilitate loans for retailers. And I'm sure all of us here have heard that in the retail business, there is only 3 things that matter: location, location, and location. Now, in spite of having heard that, I don't think many of us understand what about the location matters for a retail business. Right. Now, that is an interesting form of alternate data to try and then index. What does that mean first? Right? Is it useful for a retailer to be in a crowded location? Is it useful for them to be on a relatively less competitive location? What does that mean, right? And then be able to calibrate, build and calibrate those models to say, how does this location, which is deemed to be so important for retail businesses, does that show up in credit performance or not? So there are umpteen examples that in the small business space are relevant. This would be one of those.
Wonderful. Saurabh, we have a minute, so if you can just quickly close out on that. What do you see, guys? I mean, you see so much data. What do you guys see out there?
Yeah, sure. I've seen some very interesting examples of it. I'll maybe connected to what Alok was talking about. I've actually come across a company that provides geospatial intelligence data. What you're talking about is a 1 kilometer by 1 kilometer area where you can find out the population density. You can find out how many hutments versus brick houses versus cement houses. You can find out how many retail outlets. You can find out how many footfalls, right, in those retail outlets. You can overlay that with census data and you can look at incomes, right? So there is so much intelligence when you start overlaying these layers, right, on top of just, let's say, an SME case that you're underwriting, just basis the address where that entity is incorporated. If you start overlaying all of this, there's massive amounts of lift that you can get on risk performance, right? We've seen similar applications in agri lending, right? You right now have providers which can find out what was the yield in that patch of land in the last 3 years, in the last 10 years sometimes, right? What is the nitrogen content? Has the sowing happened on time or not, right? Overlay that with meteorology department data. So really there is no limit to how much you can do, right? The first application is SME underwriting. The next one was agri. You can take it to consumer underwriting. You can look at digital payment data. How do you pay through Paytm? Where do you shop on Flipkart or Amazon, right? Shopping features can be extended. If that helps you get access to better credit, then why not, right? Similarly, utility payment data. How you pay your phone bills. Are you a prepaid customer versus a postpaid customer? What's your ARPU? There is no limit to alternative data. I hope that gives the gentleman a sense of what kind of possibilities exist, but they are unlimited, literally.
Thank you so much. I think we're out of time, so I'll hand it back to Jared. Thank you, everybody, for all of your discussion points. I think we could have gone on for another hour easily, but wonderful chatting with all of you. So thank you once again. And stay safe.
Thanks, Prashant.
Thank you, Prashant. Thank you, everyone.
See you. Bye.
Distinguished speakers, thank you very much for joining us.